Hey there, everyone. Dave Keller here with Market Misbehavior. The S&P 500 obviously at or near new all-time highs here in mid-August, and the technology sector back on offense with a pretty impressive August so far, starting to outperform once again. However, for many investors, that means we continue to be overweight technology, most likely in our portfolio. So how do we generate some ideas outside of the largest sector in the S&P, outside of tech? Today, we're going to be using the Seeking Alpha's new Quant Growth and Income product to identify some names that are showing some strong capital appreciation, some strong price action, but also consistent dividend components as well. First, let's look at the technology sector. This is the XLK, and you can see that off of the March market low, it's been a pretty nice run to the upside, right? And you can see that April and May were particularly strong, June and July much weaker, but now here in August, a resumption of the uptrend, or what we call an accumulation phase. The performance, the relative performance at the bottom really tells the story of the technology sector, right? So at the beginning of the year, in the first quarter, technology actually underperformed slightly, underperformed the S&P 500, but then in April and May, tech far outperformed. Here at the bottom, we're showing the relative performance, the performance spread of the XLK versus the SPY. This, and I would say really during this period off the 2025 low, that's when the technology sector generally has been doing quite well. That's when mega cap growth stocks have been doing remarkably well. That's where the outperformance was, but that's also because of their weights in the indexes. And because of the strong performance, it can all of a sudden become a much bigger bet than you want in your portfolio. And this is why investors often talk about trimming positions on the way up, because you don't want your entire portfolio to be overweight one particular theme. And I think for a lot of investors, if you've been in the AI trade, that's great, but you don't want your entire portfolio to be in the AI trade. And I would say what happened in June and July probably provided a huge wake-up call, maybe for you, but I know for a lot of investors, because if you are way overweight technology, that's great as long as it's ripping to the upside and outperforming like it was in April and May. But it also feels even worse in June and July when technology starts underperforming, and those names that were such great gainers on the way up, all of a sudden when they're losing 20, 30, 40, 50% of their value, in June and July, that starts to really hurt. Now, what's happening in August, technology, of course, is starting to recover, but I think this wake-up call has been enough for a lot of investors to start to look outside of tech, and I think that's actually a pretty healthy thing. Breadth conditions have remained fairly strong, telling you that it's not just technology doing well, it's actually a bunch of things doing well. Now, how do we find those names? Seeking Alpha actually has a new product called Quant Growth and Income. We'll share some info about the product here in a short while, but I do want to just point out the general methodology here. Kind of three things that they're trying to accomplish with this new Quant Growth and Income product. Number one, long-term capital appreciation. What does that mean? That means price momentum. You're looking for stocks that have demonstrated the ability to outperform not just today, but over a longer period of time. Number two, consistent dividend income. And I think that's important to reflect on. Not necessarily huge dividend payers. I think a lot of investors fall into the trap of looking for high dividend payers, right? Stocks, and if you look at some of like the REITs and certainly like, MLPs, like pipeline companies, they can pay like 8, 9, 10% dividends. Feels really good. However, the consistency is what matters. So they're looking for consistent dividend income, companies that have not been cutting dividends, that have actually have consistent payouts, because that's what we're going to be potentially betting on going forward. And then the third one, looking at dividend safety, and I think that's the key there. They have a quantitative approach to evaluate companies and look for companies that are least likely to be cutting their dividend. Because dividend's great, but all of a sudden if the company just cuts it, there's that whole side of the argument is kind of evaporated. So we're looking for high dividend safety, and again, they have a built-in part of their quant platform looking through the dividend details and looking for consistency. Now we can actually show you the current portfolio that is in the Quant Growth and Income, and the way that this product works is I think twice a month they'll update and dig into some particular names, but they're regularly refreshing this basket of stocks to focus back into the names demonstrating those three characteristics and scoring quite well according to those models. As you look through this list of tickers, what sector do you not see a lot of? Technology. As a matter of fact, on none of these names, I would argue, glancing down this list, I see zero tech, which is actually pretty refreshing because, again, I've got plenty of great ideas in technology. I've got plenty of things that I'm looking at. But right now, I'm trying to find things that are not in technology, right? Trying to diversify a little bit. So I've hand-selected 5 stocks that are in the current portfolio that I think represent the methodology well, might give us some things to think about in terms of opportunities going forward. First one, and we've got 5 different sectors represented. First one is in the energy sector, Valero. Now, I've been kind of keying in on this particular area of the energy sector. These are called the downstream names, so the refiners, things like Valero, Phillips 66, PSX, Marathon Petroleum, MPC is in this bucket as well. These are kind of the gas station names, right? Names you're probably familiar with. There are other parts of the energy sector that are more like midstream and like upstream names, which are part of like the get the oil out of the ground and get it out to people type of thing. These are the sort of end, companies that actually sell the fuel. And allow you to gas up your car. And so VLO and the other names that I mentioned, are less mainly sensitive to the price of crude oil, which has certainly been quite volatile, but it's more to the crack spread, which is basically the spread that refiners focus on, and that's where their profits generally come from. So VLO is making a new all-time high here in August of 2026. The other names that I mentioned as well, all in particularly strong trend characteristics. So one on this chart tells us that the momentum is strong. So I think of it like a checklist. You start at the top and kind of go down. Number one, is the price making higher highs and higher lows? And the answer is yes, right? We most recently made a new swing high after pulling back and making a higher low around 290, 295. We've now resumed the uptrend. Accumulation phase is in great shape. Number two, what's the shape of the moving average, the slope of the moving averages? Well, we can see the moving averages are all sloping higher. We can see the price is above an ascending 21-day EMA. The 21-day is above the 50-day. The 50-day is above the 200-day. So that's the what we call the moving averages in the proper order. That's kind of what we want to see in a nice, strong, consistent uptrend. Now, an interesting thing happened just over the last couple weeks here in late July and early August. Look how Valero pulled back to an ascending 21-day EMA, didn't break it on a closing basis, and then finally resumed the uptrend just about a week ago. I often think of that 21-day EMA as like an initial trailing stop, right? So as long as we don't close below the 21-day EMA, I would consider a chart to be relatively healthy. We start to have a valid breakdown below that level, then I may want to start to revisit that position. In this case, everything is good. We're firing on all cylinders. Number three, what about the momentum? Is the momentum strong enough, representing that we're in an accumulation phase? And for me, that means the RSI is becoming overbought when we rally, which we have been here just most recently. On pullbacks, is the RSI remaining above 40, and that's an important sort of distinction because in bear phases, in distribution phases, the momentum will get very low because there's a lot more selling happening. Here, we're actually seeing signs of accumulation because as the price is pulling back, in this case, a number of times to right around the 50-day moving average, the RSI didn't really get much below 40. Final check, is the relative performance strong? Meaning, is this stock outperforming its peers? And one fairly consistent item we're going to see, at least with these first 3 names, is that the relative performance has been pretty fantastic, particularly over the last 6 to 8 weeks. Going back to mid-June, we can see that the relative performance at the bottom started to improve, and by early July, it's making new 12-month relative highs, and that has continued through this week. So VLO kind of checks the boxes of strong price momentum. Now, what about the dividend component? Now, this is where we go back to Seeking Alpha, and when we click on an individual name, we can go to this dividends section, and this is where we can find how a company scores based on their dividend safety model, dividend growth, dividend yield, dividend consistency. Now, we're not going to go through each of these with every one of the stocks that we've selected, but I think this is a good example to kind of dig through. So most important, I would say, dividend growth and especially dividend safety. And that's the consistency that we were talking about, right? The key here is not necessarily that they pay high dividends. As a matter of fact, Valero actually does not pay a particularly high dividend. It's around a 1.4% estimated dividend yield. So basically that implies that the next 12 months, barring some huge change in their dividend schedule, you would expect to get about 1.4% of the share price back over a 12-month period in the form of a regular, in this case, a quarterly dividend. That's not particularly high. That's actually below average for the S&P, above average for like technology, but below average for the S&P 500. So that's why it scores as a D plus in terms of the attractiveness of the dividend yield. How much of a dividend is it paying? But it scores remarkably well, A plus on dividend safety. So think about it. This is a company that pays a lower than average quarterly dividend, but they never have missed the mark, right? They kind of just been super consistent about paying out that dividend. So a low but consistent dividend can be a lot better than a high but very inconsistent dividend, right? I guess is the argument. So we're able on Seeking Alpha to dig a little bit deeper and look particularly at some of the dividend components. And then, of course, you could click on any one of these to see a little more detail and the justification as to why it scores particularly well. But that's why Valero scores well on the dividend side. On the momentum side, capital appreciation, I would say fantastic chart. Strong chart getting stronger, as I like to say, innocent until proven guilty. So that's chart number one, VLO, Valero. Second sector, second stock, this is in the financial sector, and this is PNC Financial Services. This is a regional bank based in the Northeast, and we can see, similar to Valero, this is another stock kind of at or near new all-time highs here in August of 2026. Now, a lot of similar configuration that we can see here to the chart of Valero. Stock is making higher highs and higher lows, prices above the moving averages, which are all sloping higher. We had recent pullbacks to the 21-day EMA, and then we rotated higher. The RSI is strong but not excessive, consistently above 40, and the relative performance has been pretty good, particularly since the end of May. Now, is there anything to be concerned about in this chart? So on a chart like PNC, the only thing that concerns me a little bit is what we call a potential bearish momentum divergence, right? When a stock is making new highs, we want to see stronger momentum. We want to see the RSI, generally getting overbought on those pushes higher. That implies a healthy upside momentum. That implies plenty of willing buyers. That implies probably the sustainability of the uptrend because it's driven by that positive momentum. It's not the end of the world, but it's certainly something that I notice when we're making new highs in price, as PNC has from July to August, but when the RSI is sloping downward. So we actually, in this case, have a bearish momentum divergence of higher highs in price on weaker momentum. Now, how do we get out of this? Well, two ways that this tends to resolve. Way number one, the price breaks down. The weaker momentum implies an exhaustion point in the uptrend. We start to rotate lower. I don't think you need to worry too much about that because all we need to do is wait for the price to break below the 21-day EMA. Watch for the price to break below the 50-day moving average. That could tell me we're in a, more of a larger, more sustained pullback or a corrective move, and maybe I want to get a little more defensive or hauled off a little bit. For this point, we're not seeing any of those warning signs. So scenario number one, the price actually breaks down and because of the weaker momentum. Scenario number two, the price continues higher and the momentum improves yet again. So a divergence can be negated if the RSI goes higher. So what we need here is a push higher with the RSI pushing above 70. That would be sort of an ideal situation for PNC. It's interesting because the yield curve has become more normalized, right? With the spread between the short end of the curve and the long end of the curve becoming more significant, right? Becoming a wider spread. And as a result, that steeper yield curve is usually really good for regional banks because that's essentially their business, borrowing at the lower end of the curve or the shorter end of the curve and lending out for mortgages and car payments and things out on the longer end of the curve. So yield curve, I would say, generally supportive of regional banks, and I would say the price action in PNC pretty strong as well. We can go back again to Seeking Alpha, checking out the dividend components. Scores pretty well also. All right. Third sector, third stock, Raytheon Technologies. This is in the aerospace group. We've been focusing a lot on aerospace and defense stocks, certainly related to the events in the Middle East. There's certainly an expectation that there will be a lot of spending, from the U.S. and others in terms of defense. As a result, the aerospace and defense names generally have done very, very well. You'll notice on the chart of RTX what a pattern which has happened with a lot of the aerospace names. Really strong second half of 2025, really strong Q1, and really through the beginning of March. Raytheon kind of a perfect kind of ideal chart, higher highs, higher lows. We mentioned that bearish momentum divergence. Look at the bearish divergences we can see here in like January, February, where the stock is moving higher on weaker momentum. That was one of those exhaustion signs we are always on the lookout for. Big pullback in March and April. Now, the indexes themselves pulled back into a March low, but Raytheon continued lower, as did other aerospace names. A lot of them kind of languished and underperformed in Q2. This is as the events in the Middle East were shifting yet again, and all of a sudden it felt like instead of being a huge drawn-out situation, it was going to be more localized and, shorter time frame, less actors being brought in. Aerospace and defense stocks started to come down. All of that has changed yet again as it's been more of a grind in the Middle East as more and more hostilities have sort of come and gone. There have been peace deals that have been announced and then have been negated immediately, and as a result, aerospace and defense stocks are starting to creep higher a little more aggressively here in June, July, and now into August. Indeed, it's enough for RTX to make a new all-time high in the month of August. We can see that strong uptrend met with strong momentum as well, as the stock has been overbought for most of the last couple weeks. Now, similar to the chart of Valero, this is not a huge dividend payer. The dividend's around 1.3%, but again, scores well on the consistency, which is why it's part of this group of stocks. The relative performance, again, similar to Valero and certainly similar to PNC, sort of up and to the right, and that's good. That means we have strong price action, but we're also outperforming our peers. So we're outperforming the benchmarks and with a consistent dividend, and that's really the essence of that of the product. Should have noted, by the way, PNC, I didn't mention the dividend yield over 3%, which is pretty good and above average for sure. All right, next chart, and I would say the next two charts, two other sectors that we're going to share with you. I would say these names probably less strong momentum from the first three that we've talked about. The first three names all at or near new all-time highs here in mid-August 2026. These next two have pulled back in varying degrees. So we're going to talk a little bit more about the tactical time frame and how that relates to more of the long-term sort of structural story. So Postal Realty Trust, PSTL, is a REIT. It's in the real estate sector. You can see the dividend, which is pretty common for REITs, is higher than average, right? So it's an over 4% dividend, and that's after the price has gone up quite a ton, right? If you think about it, the dividend yield is basically the quarterly dividends, right, over the next 12 months, but as a percentage of the share price, right? So what am I paying for a share of this stock, and how much am I expecting to get back in the form of a dividend? So remember, when the price goes down on a stock, the dividend yield often goes higher because if they pay a consistent dividend, but the price is going down, that means the denominator is going down a lot in that ratio. So a lot of times when stocks like this have gone down, or when REITs have gone down, the dividend yield all of a sudden looks bigger and bigger. So it's paying a pretty handsome dividend on a percentage basis, even after the price has gone up so much. I mean, this is the stock that's outperformed the S&P significantly in 2026. So strong capital appreciation, which again was one of the three bullet points that we shared earlier. Now, this one looks a little different in that we've had quite a bit of chop recently. I talked about the 21-day EMA and even the 50-day moving average as being sort of levels of risk that I use. This stock has gone, and this REIT has gone below both of those. What's happened now, though, is it's settled into kind of a range, similar to what the S&P and the NASDAQ have done recently, where they settled into sort of a sideways consolidation phase for a number of months. Now, when you have a stock that's settled into a consolidation phase, you want to keep a watchful eye on the level of support and make sure that holds. So the good news is this stock has found support right around $22 a share in May, in June, and now again here in the last couple weeks in August. So that seems to be a pretty consistent floor on the chart of PSTL. So now the question is, when does the capital appreciation sort of resume? And I would say at this point, the way I think of it is we're in moving average limbo, right? We're between the 50-day moving average above the current price action. We're still well above the 200-day moving average, which is well below the current price action. So I would think with a narrower lens from a tactical time frame, we watch the short-term level of support around 22. And as long as that holds, I would say this chart is still okay. It's not great, but it's still okay. We break below 22, I would say not okay, because what that would imply would be a retest of the 200-day moving average, which would be another 3 points below that support level. So kind of a long ways down. However, we're very close to getting back above the 50-day moving average. And when I have a stock that's sort of between these two moving averages, a break back above the 50-day can often be a great sign of a resumption of the longer-term uptrend. You can see that on the same chart back here where we broke below the 50-day moving average. We spent a couple weeks below there before breaking back above. And that break back above the 50-day was a great sign of significant upside potential. That was right about here. Also note that as we continue to push above the 50-day, the RSI pushed above 60, which implies strong upside momentum. So the good news is the stock for now is holding support. The good news is the RSI has not gone much below 40, all which I would say, agrees with the long-term bullish thesis at this particular point. And as long as 22 holds, I think that's still true. If we can push above the 50-day moving average, and if that can be combined with stronger momentum, I would say that the price action would resume sort of a bullish configuration. But again, all of that with the backdrop of a strong and consistent dividend. This one actually pays a higher than average dividend at over 4% as an estimated dividend yield. All right, the last chart, and this is one that's actually just starting to improve here in the last couple of weeks, Barrick Gold, right? So gold stocks have started to improve as the chart of gold has started to improve as well. Now, charts like this are really tied to the underlying commodity. Gold had an incredible run going into this year. January, February saw a pretty major top, and then for the last 6 months, gold's been in a downtrend. Spot gold found support right around $4,000 an ounce, and now in the month of August, we're seeing gold and silver both start to rotate higher. And that's mean mining stocks, which have been underperforming the S&P pretty consistently in 2026, are starting to improve a little bit, right? So look at the chart of Barrick Mining, lower lows in price, downtrend in relative performance. Look at what's happened in the last month. All of a sudden, we're not making lower lows, we're making higher lows. We're not making lower highs, we're making higher highs. We're no longer below the 200-day moving average. We've just in the last week started to have a little bit of a move above the 200-day moving average. The momentum with the RSI was consistently, really below 60, and in a lot of ways, kind of neutral momentum between 40 and 60. But we can see in the month of August, the RSI has pushed above 60. The relative performance starting to improve as well here. So I think this is more an area of emerging strength. And I think that's why it's a compelling sort of alternative to some of the stocks that are a little more extended that have already been in these uptrends, right? So one of the things that I scan for all the time are stocks making new 3-month highs. So I always look for stocks making a new 3-month high because that, to me, implies a new accumulation phase. We're not quite to a new 3-month high. As a matter of fact, at this point, we would have to get above kind of 46, 47 to complete that rotation. So that's where I might look for an interesting, break higher, a confirmation of the new uptrend. But I would say in the meantime, stronger momentum, stronger relative performance, and assuming a push back above the 200-day moving average. That could be a really interesting idea to keep in mind. And again, not a huge dividend payer, similar to some of the other stocks that we've talked about. But again, going back to the Quant Growth and Income model, it's not about the amount of the dividend, it's about the consistency, right? And it's about the dividend safety, which is, again, built in as part of this Quant Growth and Income platform. So there you go. Those are 5 stocks in 5 sectors outside of technology that score really well in terms of long-term capital appreciation. They also score really well in terms of consistency and safety of the dividend component. All of this is supported by the new Quant Growth and Income product at Seeking Alpha. And again, thanks again to my friends at Seeking Alpha for being long-term supporters of Market Misbehavior, but also providing you as a viewer of my content 10% off the new Quant Growth and Income product. We'll include a link below, or you can scan the QR code that you see on your screen to learn more about Seeking Alpha's Quant Growth and Income. Thanks for checking it out, and thanks so much for watching me and my content here on Market Misbehavior. My name's Dave Keller, reminding you it's always a good time to own good charts. Take care, folks.